Good morning, everybody. Welcome to the Flow Show. Hope you're all doing fine and dandy this fine morning. Morning, Kate. How are you, mate?
Ryan, everybody, good morning. We are ready, are we?
Just about, I think. Ready to rock and roll. Should be anyway. We've got some good old action going on in dollar yen at the moment, so we're going to keep an eye on that and just explain what's been going on in the latest headlines. We'll kick off with a little bit of data over in Japan overnight. Let's get rid of all that crap. Services PPI over there in Japan up 2.1%. Bank of Japan core CPI up, beating expectations 3.3%, but matching last month. So still sticky. Services prices is something that a lot of central banks are looking at as the big driver of inflation at the moment. Well, definitely more so than manufacturing, considering that's down in the dumps. But as you can see there, no relenting in the price pressures over in Japan. And surprised that hasn't had a bigger effect in the yen at the moment, but there's more cooking in there. Looks like we're firmly in the grip of month-end stuff with the dollar remaining well bid all round. We've had Suzuki popping up a couple of times overnight, reiterating he's in communication with foreign authorities on FX and closely watching FX moves with a great sense of urgency. He, as I say, he was out mainly during Japanese time, but then he popped up not so long ago, and actually you can see now there's a bit of nervousness in dollar yen because his comments came out and we saw only a 20-30 pip drop, but enough to say that now the market is definitely getting a bit nervous up here of the intervention threat. We also had Economic Minister Shindo saying it's important for currencies to move in a stable manner reflecting fundamentals. Now over to Kishida. He sent out his minions to go and discuss this, all these fiscal measures. Kodo reports that he is thinking about tapping reserves to encourage wage hikes. He's also apparently asked that these measures do not exceed last year's amount, so putting a bit of a limit on there, but still ready to get the fiscal bazookas going. The government maintained its overall view on the economy in September. Still, the economy is recovering moderately, though they did raise their opinion on corporate profits for the first time since March 2022, and things are improving as a whole. So, Kay, what are your thoughts coming in? Again, we're hearing this communicating with foreign authorities. We're seeing the data is still sticky on the inflation front, and Kishida putting in some restrictions on his bazookas, it seems.
That's quite a lot of information, actually. Yeah, it is, and it can make month-end a bit confusing, dangerous. Now, first of all, let's take it one by one. The government saying limited it to last year's. They're capping the extra spending. They're not capping spending. They're capping the extra spending. So it still will come on top of whatever they did before. That is one thing. Then the inflation remains very sticky. I also saw something about another point of measurement. We just crept, the corporate services index. We just crept above 2% as well, which is interesting. So that is another thing. And then there's those comments, and there we are back on which calendar should we be watching? Is where they're going to move at the end of this year or at the end of the fiscal year, and that's going to be mega important for the monetary policy and the outlook for what could happen to the Japanese yen. And then we have Suzuki. It's undeniable that now they are seemingly looking at that trade-weighted index, or NEER, rather than the speed of the move. So that's a bit of a change, and we need to adapt to that as well. The fact that they talk about being in contact with foreign authorities, that is not abnormal. Okay, they may not have said as much, but I do think they actually mentioned it last year as well, but once. They are in contact because they need some kind of green light, which they got, by the way, from Yellen to start to sell dollar yen, for instance. But they're also watching at this, the one that you're showing there, the NEAR and the TWI, which is below levels where they intervened last year. So I think we need to adapt what we are watching as well, which is the speed rather than the level. We are going to have to watch levels as well. Now, in regards to that, they know what's going to happen on month end, right? So we've seen people calling for fierce dollar buying into month end, and yen being likely one of the most affected because of the equity market divergence. So we will have to really monitor it closely. Are they going to intervene? It's a tough call. Are we going to get a couple of lines like Bank of Japan is checking rates? I think that's very plausible. Are they going to stop it at 150 if we see it? That is also possible, because there is this risk, let's put it that way, of an acceleration into month end here. So yeah, to me, they actually, it feels to me like they made a pact, and Bank of Japan is going to take care of the government finances, and so bye-bye, which always was a big concept in Japan, by the way, bye-bye to central bank independence, and the MOF is going to take care of the value of the yen. So that's how I look at it. But we need and really, I think it's relatively important that the market knows, and we know that they are really closely watching it. I mean, you wouldn't come out every day with the dollar yen being. So we had last Friday, so in 3 sessions being up, let's say 100, 150 points. That would normally not alarm them, but I think now the level of this DWI is getting really important. And if the yen continues to weaken with a standstill dollar yen, but the rest of the currency is starting to correct, for instance, like a higher euro dollar or higher cable, just to mention those two, because those and Aussie dollar perhaps, because those 2-3 are the main currencies in those indices. Then I think we might actually be close to them trying to stop the rotting yen for now. So I'm going to be on my guard. I have my my call running, but I did hedge a bit more of the nominal this morning, and just be ready for a move either way on this pair. And if we would get this month quarter end rush into the dollar without them intervening, then I think Friday is a day where we should really be on very, very high alert. That is my feeling going into the rest of this week for the yen.
Yeah, I think it might be a bit dangerous leaving yen shorts on over the weekend. If they are watching this month in stuff and happy to let it slide and do what it wants to do, and see no reaction after, then I think it's a big risk for the Tokyo Open on Sunday night, Monday, if they do decide to tap it on the head. I've most certainly tightened up my longs, the stop of my longs now, 50 pips into profit on my 147. So I don't know. I may, because of that risk, I may close out Friday, depending on where we are and what's happened, if we're still up here. Because I think, yeah, maybe the intervention risk for this weekend is going to be particularly high. And, you know, we keep mentioning these comments that they're dropping in about being in contact with international authorities. It does smell like this time they may get their pals to help them along by selling their own currencies versus the yen around the different jurisdictions, if you like. Which they didn't do that, did they, in the last intervention? It was just them on their own, wasn't it?
Yeah, the last ones I reckon they were on their own, although if I recall well, the last leg they did it on an early afternoon our time, if I recall correctly, or at least one of the legs.
Yeah.
They did it around in the afternoon, so they may have had a little help. They will, but if they would have had, I guess that after the fact, other central banks will likely report it.
Yeah.
That is, I think, in the somewhere in the rules, that they say if they intervene on behalf of other central banks, that they kind of report it somewhere. They did in the past anyway. Now, are they still going to do it? I don't know. But and we have to be clear here. We are not giving any investment advice to any of our viewers. We are just talking about what we think is the most logic thing to do here. But
Yeah.
having said that, I think it is wise. Even if I think the end game in the very long term is going to be for a much lower yen, I think if you look at it on the short term, and the long term, I mean several years. Okay, the short term, like what's going to happen for the next coming days, it's just wise to take it into account what they are saying, because they are talking very frequently. That we have to take that into account. Yeah.
Yeah, this is just us, highlighting the risk, and that the risk might be greater for intervention this time in terms of effect than it was last time. The Bank of Japan going on their own, but this time if the ECB, the Fed, BIS, SNB, whoever pop up alongside them to intervene, it's going to have a much bigger impact on the market. And you've also got to understand the follow-through knock-on effects from that. In that these central banks, they may sell their own currencies versus the yen, but they will be getting out of those sales pretty quickly, diversifying into other currencies, because they're not going to be net sellers of their own currency. So, don't be thinking that just because euro yen gets smacked, this is the example Kay used in the room, that euro dollar will get smacked alongside it. That may not be the case. It may follow initially, but then suddenly might find a bid if all the agent banks and whatever are then getting out of euro yen shorts into euro dollar. So we're just highlighting that there's a greater risk of a wider effect from this potential intervention should it happen. And you need to be aware of that. You need to be aware going into things like weekends. It's not just yen that you need to be worried about. So make sure your trades are protected. Make sure you've got, you're not sitting there with no stops because you think you don't need to run a stop. You need to be very careful. We are highlighting the risks of losing money in this, let alone making money. If you make money, fine and dandy, but we don't want to see people losing money on this. So just be aware of that. But anyway, moving on. ECB wafflers have been up and about. ECB's Lagarde was in EU Parliament saying that recent indicators point to further weakness in the third quarter. Mainly, she reiterated the ECB's stance as per the last ECB meeting. She added that the faster the ECB reaches 2%, the less pain there is for consumers. Well, we'll see about that. ECB Schnabel said activity in the euro area is clearly moderating. There isn't yet an all clear for the inflation problem. ECB Simkus, we wouldn't rush with an answer on rate cut timing. Again, questions or topics around rate cuts. We should discuss PEPP sooner rather than later. That's in regards to halting or increasing QT. ECB's Muller says we're not expecting more rate hikes as things stand. Coming over to the US, and Fed's Goolsbee says the risk of inflation staying higher is still the bigger risk. The current path is unusual for inflation to fall like it is without unemployment rising. One view is that monetary policy takes a long time to work through the economy. Fed's Kashkari says there's still more work to do on services inflation. There's that comment on the services aspect of inflation. may need higher rates and keep them there for longer if the economy is too strong. May need to cut rates if real rates are tightening. He expects one more rate hike this year. Over to the geopolitical front. China's been out and about. They had the VP met with the EU trade chief and said we'll strengthen cooperation and coordination of macroeconomic policies, so all friendly sounding. The Nikkei reports that China, Japan and South Korea are going to meet to revive trilateral ties. So again, we keep getting these headlines where everyone seems to be making an effort, and then 5 minutes later we get opposing headlines or headlines that suggest things aren't going to go as smoothly as that. One such example is for all the US talks about joint cooperation on economic and financial measures. They've decided to recognise the Cook Islands and other islands that are in dispute around the South China Sea that China lays claim to. So they're officially recognising them in their own entities. So it's give on one hand, take on the other regarding this geopolitical stuff. But anyway, we'll see what comes of it. That's it for the headline front, as far as I can see. Kay, any feathers you plucked out the air?
No, just an opinion and a bit of a warning sent out, and I don't know whether he meant anything by that, but I've seen Jamie Dimon from the JP Morgan Post saying that the market is not at all prepared for rates to go to 7%. So I don't know what he knows, but it's the boss of America's most biggest bank, or the bank which is the most in the spotlight, and himself as well most of the time. So I don't know where he got that warning, but if that were to be the case, then the market will let's call it softly saying we'll take notice. I think if that goes, then it's Armageddon, really.
Yeah.
But for the, yeah.
No, go
on. I say no. For the rest, I think you covered most of it. I think we need to highlight as well that PBOC is really fighting hard versus the CNY decline, CNH decline. They continue to fix, and today again was a record defensive, the biggest defensive fix from the start actually of this whole exercise. We have to take it into account. It's one of those. Now we've maybe perhaps done watching the S&P to intervene aggressively. We need to watch the PBOC, because in the meantime news out of there is not really brilliant, but yet they are trying to kill the speculators there. So we have to continue monitoring that.
Yeah, definitely, mate. Just back to the Dimon thing, and I haven't read the piece, so I don't know what the context is, but it is a potentially valid warning. I mean, everyone's calling the top-in rates, assuming rates can't go higher, which means they're not looking at the potential if inflation doesn't do what it's supposed to do, and it does turn up again. Central banks might be forced to hike more, and then they may have to get up to 7%. And that is something sitting here now the market isn't prepared for, which means if that likelihood starts to pan out, it's going to be another big reprice in everything, yields, the dollar, all currencies, lots of assets, and it will be a bit of a shock to the market. It may be the sort of black swan event that I know Dale likes to talk about now and again, and Blake as well. So it's a valid point without knowing the full context. It is a valid point that the market is not ready if there's a shock and rates have to go higher. And why not? Rates had to go to 0 for such a long time. Who's to say they can't go higher for a longer time?
Yeah, the thing is, if they would be forced to do that, then we will really have to watch very, very carefully what's going to go on in markets, because I think the equity markets are absolutely going to tank if that were to be the case. And also, and that's a bit of a paradox, right? What the Fed needs to see now is actually, because of the other side of their mandate is employment. Is actually seeing the unemployment rate go above 4% to counterbalance, sorry, any uptick in the inflation, and to keep them on their standstill. And I think, Diamond, the context was that he was making some parallel with what happened in the 70s, the second round inflation as well. I think it's more like comparing historical events. But yeah, I mean, it's something that we just cannot completely rule out, right?
Yeah, exactly. You've got to keep these things just at the back of your mind. May not come to pass, but if you're aware of them, then forewarned is forearmed, as we like to say. There was one other headline that came overnight, and that apparently is the Republican and Democrat negotiators are apparently nearing a deal on a short-term spending measure to keep the government open after the 1st of October. Saturday is the deadline for all this to come to pass. So it won't be a great move if it's another short-term can kick, because then I think that puts us to the end of the year, and then they will have to do it all over again.
I mean to have read it's only for 4 weeks or 1 month or so.
Oh, it's even shorter than that, is it? Oh, blimey.
That's what I kind of understood reading through it. Perhaps I misread it, but would only be for 1 month, which is actually, I think that is counterproductive.
Yeah, that might not be seen in positive light at all. But yeah, it will keep getting, if it's a short-term can kick, be it a month or the end of the year, I don't think the market's going to take kindly to that, because it's just delaying this mess that's going on, and markets don't like uncertainty. It's all right kicking it for a year, 2 years, everyone forgets about it 5 minutes later. But if it's dragging on, the market usually going to start pushing the envelope, if you like, and making them sit up and take notice. But we shall see. This, we're going to have this all the way through the rest of this week, no doubt. Excuse me. Right. Well, let's get stuck in some prices then. As we said, we saw what happened to dollar yen. It had a break of 149. Called a cold up there, had those Suzuki comments. We kicked down below. We're struggling to get back above 149. In fact, we're not. So we're probably going to do a little bit of sideways action. Watch the clock into the hours. If we're seeing some month-end, quarter-end stuff coming in, the market will likely start doing that on the hourly marks when the fixes come in. It does seem we haven't got the same sort of PA we had yesterday, though. Okay, we're on a bit of a grind yesterday all day. Topped out. It doesn't seem like we're having, apart from this morning, which that might have just been the 8 a.m. man catching up and whatever. It's looking a little bit even. Do you think there might have been a bit of front running of all the model calls yesterday?
Yeah, I wouldn't rule it out at all. We've seen this kind of action when we have the month end on a Friday, where they start to anticipate it on the Tuesday already. I'd rather think that the bigger day may be tomorrow, but then I think we also need to take into account the data that will come out this afternoon. So some people, like, we see a little bit of a rebound in the euro from the lows. We see a little bit, well, dollar yen is due to Suzuki, of course, but we're seeing cables starting to sort of hold, although it's still quite weak. I think the market is now waiting for the data this afternoon. If they come out either positive or even a standstill, and I would say like not showing any negatives on the dollar, then I think the party can start again this afternoon already for a bit dollar. That's about it. So I think a bit of position management into those data today. I was actually looking for a little bit of a dollar setback somewhere to re-enter a bit. I'm still a bit long dollars, but just smalls. And that's, yeah, I think it's ahead of the numbers. So because it's a bit of a risk, right? Because the Fed is always talking really about the consumer when they do their meetings and stuff. So it is going to be a quite important set of data this afternoon. We got the consumer confidence, and then we've got some housing data. I think the Richmond is not as important as those two. So yeah, we'll have to watch the data first and then make a decision on what's going to happen into the end of the week.
Yeah, very much so. We got the big numbers, I think, is going to be house prices. That's something you watch. It's July data, so it's a bit lagging, but you just watch for general trends. Home sales is going to be fairly important. New home sales, that'll tell us if there's any weakness. But the consumer confidence is going to be the one to see if it follows the Michigan and see if the inflation expectation numbers drop like they did in the Michigan. Quite a significant drop in those there. So we'll see if it follows suit in that. For cable, just talking about that, we've done the fib of this leg. So we had the leg from March, the secondary move up to the 131 highs. It's been a one-way street down, and this is cable in a nutshell, really, because just as it's a one-way street going up through all the data, central banks and everything else, it's a one-way street coming down as well. The bigger levels going to be coming up now into 121, 120.78, that fib, down into the big 120. We're all going to get levels that if these are tested and hold, then maybe at least we see a bit of a pause at the very least. If we carve through those pretty easily, it's going to suggest that there's more to be done on this, and then who knows where we're going. But we're going to get into, as I say, that 38.2 is going to be a juicy level. 121 and a half has been a juicy level. So, you know, we're getting again into a bit of confluence down here of the tech. Doesn't mean you should pile in, catch the knife, and you know, put your feet up. You've got to know that this is a strong trend. It's been going on for months. This isn't just a 1 week thing, a couple of day thing. So if you want to try and catch the knife, know which way you're fighting the trend. You know, you need to keep your trades manageable, maybe keep your risk a little smaller, and because you know people are going to be coming out trying to catch this knife in cable after this performance. So always got to manage your risk when you do such things like that. Euro sterling had a little bit of a nudge back from the 87 yesterday, but now we're knocking on the door once again, matching the prior highs. Again, this is probably more to do with the speed that cable's going versus euro dollar, as opposed to any real difference. But again, you can see that pound weakness generally coming into this one. So still waiting to see if we get a kick above that 87.15.20 area, which is a quite significant top on that. I'm still just managing my positions. Euro CAD. A lot of eyes on that one at the moment. It's one I tapped into the fib yesterday just for a little tech trade. So I was long into there, 67 I got long. Not bouncing awfully that much at the moment. So it did look last night that we might be holding below this fib and this 142.50 area. There were just some tentative signs that was happening. I was a bit umming and ahhing, as you can see there. I was just umming and ahhing about whether to chop in my long overnight and just forget about it, but I thought, nah, sorry, I've taken a bit off. I've reduced the risk, so I'll see what happens. We're back above and we're holding, so technically it's doing the right job, pushing up, but not exactly rockets. Nothing really changes in this until we get above 43, maybe that 43, 20, 30 area. Definitely 43, 60, 70. We need to retake, so take a bit of the pressure off. While we don't, that keeps the downside in play for that. So just a little tech trade on that one. I'm not really looking at an awful lot else at the moment. It's really a case of just seeing what's happening. You know, looking at gold, I'm still looking to see if we get a move down to the bottom of the wider range, which is down at the 1885s. That's kind of skewy. There we can see the range down there. That's the area I'm really looking at for potentially taking along. But in the meanwhile, 1930 is still doing a job. We did have the break. You know, we mentioned this last week. Holding here, break up. got into that high area that we saw, back in early September, but then we're back below, holding below this 30s. So this 30 is still a little bit pivotal here, still quite an important number. Again, we've got a secondary area down here, 1916s, bit of an on-off one, bit more wishy-washy, not as strong, but you can see it has moments where it's support and resistance. Stay under there. We're probably going to get a test of 1900 again, and maybe even down to that low. And I'll consider, depending on the type of move that takes us there, picking up some longs into that 1885 area. Oils, again, looking like it might be done with the tops right now. Having a little bit of a pullback, just etching a new low. So after it came off the top here, made a low, just made another new low, which just changes the complexion a bit of the rally that we've seen previously. So it's probably going to stiffen up this resistance area. Doesn't mean we can't be rocketing up to 95s or 100s, but the market is now seemingly happy with the level it's at. We obviously had those headlines, I don't know whether to believe it or not, that that Total Energy, I think it was the main buyer of oil in a lot of this rally. If that's the case and they finished, might be a reason why we topped out. But that's keeping us things a little bit more neutral at the moment compared to the rally we saw before. That is having a bit of an on effect in dollar CAD. Again, we just can't get back above this 135 and hold it. So it looks like we've got a mix of stuff going on here. A bit of the weaker oil, bit of the dollar strength, but we're not making any massive inroads. It's stepping up, it's stepping up, it's stepping up. So it looks on balance perhaps like the upside is more favourable than the downside, but it's going to need us taking out that 135 area. Then we've got the next level, 135.50 to take care of. But this one, I'm still potentially looking at the short side if we get any juicy levels up into the 136s, purely because I think the Bank of Canada might be forced into another hike, or at least talking more strongly about one. I still think that the pressures on the Bank of Canada, or on Canada itself, favour a more hawkish stance. So I'm just going to keep an eye on that if we do get a move up on that one. Okay, do you want to have a little mooch around?
Yeah, you covered already a lot of stuff, so I'm not going to add too much today. Cable, you've highlighted the levels. I think we're on a little bit of a level right here, actually. So I did manage my position a little bit. We are on a bit of a level. We're turning around, and today may be one of those days where you are a bit, or we are a bit careful with our dollar longs or so, just in case we get those we get weaker data all of a sudden out of the US. So I'm just being cautious. I still think into month end we may see that rush into the dollar. I'm not saying that we are going to go down to 117s, but the level that already been talked about in those 120s, and then at the end of the month, I'm really looking at the rest of this week like one big market or trade, or just looking at it as a whole, and then taking into account what the people in Japan want to do with their currency. So one of the currencies which is undeniably still offered is this cable. We've also seen the differentials on the sterling and the dollar. We did just slightly up today, but it's still remaining very weak, still remaining below prior levels, and especially still remaining into negative territory now, while where we have been in a pretty positive territory for quite a while. And look, when we did the top in the cable euro dollar, that's where these things started to turn around as well. So they are still a driver. and for as long as we're in negative territory, it's more likely that the sterling may be putting that last leg in lower. I'm speaking the conditional way here because the maybes and the stuff like that, because I don't know what's going to happen at the end of after the end of the week. I'm starting to think that if we see a big rush into dollars for the end of the week, we are going to have to be a bit cautious. On the S&P, I think we're in a bit of a zone here in those low 43s down to 43 the figure, where other people already were talking about 42. I got 42.40, 4200 is coming up as well. If we see this towards the end of the week, not ruling it out. Watch those data coming out. If we get like slow worse, but slow worse, it could be good for an intermediate rebound on the S&P, for instance, up to 43.5, and why not like push a little higher up to 43.85? But it shouldn't happen with like a consumer confidence which is crashing away, because that's going to only be a temporary bounce on the back of lower yields. But and then I think if the consumer is not doing well, I don't think stock market should hold up. But that's just my personal view. So that for the S&P, yeah, the dollar yen, we've spoken about it. We are in this area, and if one believes, and I tend to agree with them, what should happen on month end, quarter end, we may be up to 150 and getting more, at least warnings from the Ministry of Finance. And as we have said earlier in the show, I'd be a bit worried now. I'm the higher it goes, the more I'm going to cover of my call. And if we really get a blowout here towards the end of the week, I'm probably going to be covered completely, because I think that next week may be we may see, first of all, a bit of a natural setback on the dollar, but also we are running into really intervention risks here. To turn this around, let's look at the other side. To turn this around, we need to start to get under levels of the prior high, 148.5, but that's very close. I think to really start to turn dollar yen around, we are going to have to break 147s. From mid to low 147s, I think that's where this market is going to get nervous if we get back down there. Don't forget that people who have, and there will be a lot of them, people who have been buying post Bank of Japan meetings before, people who have been buying setbacks, they are actually doing very well, because they in the meantime also getting money to be short yen. So I really think that it's going to take more than just 50 or 100 point setback to discourage those people. I think it's going to take a break below 147.25, call it 147, for them to start to really get nervous. And then I think if that would happen, then we could see a bigger setback. But let's not front run the events. For now, we're trading around the highs. If you want to look at the crosses, I've already talked about this one as well. Kiwi yen is getting into those highs again. We're trading 88.75. I think in the next percent, which is relatively your $115 yen as well, we need to be a bit careful for what's happening there as well. I'm, for the time being, not going to counter trade this, but I'm going to be a bit monitoring what's happening in the Kiwi, because this thing is really very strong. Kiwi is holding very well. We're getting closer to this 59.90 as well, and it's holding despite the dollar doing well. The Kiwi is holding very well as well. This is one that I'm going to monitor for the start of next month as well. If we get a setback just because of the dollar into the end of the month, this one on the other hand, I think he may start to hold those levels, but it's a multiple day monitoring. Aussie is a little different. Mooching around here. I'm not sure what to do with the Aussie. I'm actually not really watching it right now, people say about this 64, 10, 15, it's already holding whatever, but I really think it's just hopping up and down, and we will have to see what happens into month end.
Have a quick look at Aussie Kiwi, mate.
Yeah, I was just going to pull it up. It's really, it's turned around quite dramatically, actually, since we had the test of this this fib here. And I highlighted that in the room. Stupid me, I didn't even trade it around there because it was like a multiple top. And now we are already way back below. Kiwi data have not really surprised me compared to the Aussie data, but the market is really trading it very very heavily to the downside right now. I don't really know why, to be honest. But anyway, we're coming into levels, interesting levels, 107.40, 107, low 107s, and then especially here, this 106 3/4, 107 the figure. That's going to be one to closely monitor if we get down there, and then you always have to look a little bit at what's happening on the Chinese yuan as well. What did you want to say?
I'm looking at that. I'm looking at that trend line as well. If you zoom it out a bit, it comes from
This one? That one.
Yeah, mid
This one here.
2020s. Yeah, because we've got this still got this magnet effect around that 108. So yeah, I might have a look at that trend line just for a little counter trade to see if we get back to the 108 mean, if you want to call it that, because we're still mooching around that. But yeah, it's had a little look up on the upside. Didn't quite get up to that 110, 111 area. But yeah, we might have a little look on the downside. I'm not keeping an eye on that one.
You want to sell close to 108?
No, I'll buy down into that trend line
here,
for a move back to that 108.
Yeah, it's possible, mate. Because it's been a few lows here as well. Okay, we went through it. The thing is, I don't really know the reason exactly why the Kiwi is going so strong compared to all the rest. We had a bit of data out, but I mean, is it justified to do? Perhaps there's something in the budget also that we haven't seen to strengthen the Kiwi.
Yeah, it just seems like there's just been a bit of a sentiment change over the Kiwi. Just in the commentary of late, people thinking they may look to hike again, or the economy's not doing all that badly, soft landings, that sort of stuff.
Yeah,
but yeah, looking at wholesale.
I think for the yen as well, we have to look at this. I haven't put any lines or charts on it, but because I mean the top end of the allowed 10-year JGB band now is at 1%, and this is sort of what I was telling since the last meetings and when they changed, that in my opinion they are, even though Bank of Japan continues to buy JGBs, okay, but I think over time they are going to slowly let it go to that 1%. That is still my base case for this. So this is this where they widened it? No, here, July, right? End of July. So yeah, I think they will slowly let it go to the 1% mark. But if you look at where historically Japanese yields are coming from, 1% is not going to scare the crowds. If they do it on a very slow basis, unless the rest of the world falls apart, and I always need to add that, unless the rest of the world falls apart, if they go slow enough, let's say for instance it takes until April or March of next year. And as you can see, there's quite a big level here at 1% as well. It's not going to change too much for the yen, in my opinion. It's only 25 BPs. If the rest of the market, if US 10s, for instance, stay at 4.5 or are at 4.75, the yield differentials will not have done anything. If it goes slow enough, okay? If they all of a sudden say that, okay, now we are okay to let this thing go, then you will have an impact on the yen, because you will be at 1% or 120 even overnight, or so to speak, in a few sessions time. So for as long as this goes really slowly, I don't think it's going to change much of their for the yen. Yeah, Gordon, I see Gordon, Japan is insolvent if their funding costs get to 3%, but their funding costs are nowhere near 3%, right? And you can count on the Bank of Japan to not let it go to 3%. So the 20 years is around 1.5. The 30 is about 170. I think the long end can go to 2% perhaps, but I think then we are going to see them trying to stop it as well. Don't forget this government stimulus. They're really, I think, walking hand in hand with the Bank of Japan, and the Bank of Japan is just there to fund their stuff. And the one thing as well, and then I'm stopping about this yen and those debt things. Since I started to work in markets, which is more than 40 years ago, I haven't heard anything else than the debt is a problem. And we're 40 years later, the debt is still a problem. It's still the biggest problem out there. And I heard it for about 40 years. And you know, Japan is in MMT, right? Since the start of Abenomics and Kuroda coming on, they just haven't given the baby a name. Ask me whether Japan is going to get insolvent. I think I'll be well retired, and hopefully retired, or even 6 feet under before they go bust. You know.
If they're insolvent, then I just to think what the US is, but there isn't probably, yeah, there isn't one country, there isn't many countries that are solvent right now. Looking at the numbers game, but you know, as Kay says, we hear that story every day. They're solvent until they say otherwise. It's probably the case in hand.
So in the last one here, silver, gold, Ryan already showed it. For me, gold is just, it's starting to react to, I think, these yields a little bit, and then the rest is month end. Because the funny thing, everybody always talks about the FX in the month end, but I'm pretty sure that there's something going on in the metals as well, because usually we do have a bit of a move into month end. So for silver, it's got this setback. I think it's all also to do with yields. For the end of the month, I'll see what happens here. I might just hold back until we see really what's happening in month end, but this area is a zone of interest to me, 22.25, 22.5. Back over to you, Ryan.
Thank you very much. Well, just a couple of points of order before we finish up. I've just popped a link in there if you want to check out Michael Brown and myself on the Trade Off UK. You can hear our latest thoughts on central banks and the like. Also, there is no flow show Thursday because myself and K-Man are heading up to the Big Smoke for an FX event thing going on, run by Bloomberg. We decided to take a day out and go and check that out. Going to have a meet up with a few people. So if you're in London, fancy joining us, check that out. You can. It's free to join. I'm not endorsing the event or anything like that, but we're using it as an excuse. So there'll be no flow show on Thursday. Are you listening, Bran? Because I know you'll forget that come Thursday. Anyway, that's it from today. Watch out for that data later. Watch out for that intervention risk and the jaw bonus. Trade safe, keep well. Thank you very much, Kate, for your input. We'll see you all tomorrow.
Cheers, guys.